Last week, all of the good news being priced into the market was confirmed with Nvidia's insane earnings report. But now what? I mean, what else is the market possibly looking forward to, and is it good or is it bad? Well, Thursday we get the PCE inflation report, and we know that 2 weeks ago CPI came out hot and caused a nasty gap down. So should we start pricing in some bad news? Well, let's take a look through the data points and build a logical game plan for the week ahead. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, solid green-bodied bar with very minimal upper wick and very minimal lower wick. If anything, maybe a little bit of buying pressure here near the lows, a little bit of selling pressure here near the highs, but nonetheless, the buyers were able to close in the top end of the weekly range. Certainly buyers in control. If we think about location on the bar-to-bar count, definitely a higher low as well as a higher high, paired with a new all-time high close as well on the weekly. It's very hard to say anything other than bulls on parade. If we're thinking about weekly trend, we've certainly got lows, maybe higher lows, highs, certainly higher highs. We're sitting on the highest high in the trend sequence, so we know if there is a pullback, which as of right now there is no indication of, but if there's a pullback, we can certainly afford a higher low. There's a couple of levels that are really top of mind here on the weekly time frame. This was a bit of a 2-bar range, and of course it was just 2 weeks worth of price data. So if we were to get a pullback that looks something like this, really makes more sense as a daily higher low pullback, but 503 is very interesting, keeping us outside of that 2-week range. So that would be the first stop. The bottom end of that range is really up next, and then this level is still very much so top of mind at 480 down to roughly 477 as a weekly higher low. There's nothing wrong with that level because as we come in with a Fibonacci from the bottom of the October move to this all-time high, we're still well above our 38.2, so no issues from a depth perspective on a retest of this potential level. Just as a reminder, it is confluence with the previous all-time high, and it's the top of this as a multi-week range. So 480, 477, weekly line in the sand. But how might we actually get there? Is there any way that there's, some possible bearish trade here on the weekly? Let's take out this fib from the low of this minor pullback to the all-time high, and if we crack the lows of the 2-week range, we would be underneath the more minor 38.2. I think that might open the door for a larger weekly pullback. The other reason that this is sort of top of mind is because if this is a 2-week breakout, right, then this that then comes back into range would be a look above and fail. And suddenly if you break down underneath the bottom of that, now the door is open because you have overhead supply. Now, once again, I want to remind you that the structure and location is bullish. It's just one possible way that if you're trying to look for a bearish setup, you'd have to be patient for a breakdown of these lows, which are much closer to 490. Interestingly enough, if we bring out the anchored view apps, I've added a new one for this week. If we added view app to this location right here, the bottom is going to start offering confluence of that range, right? So that anchored view app is important. Once again, 490 is loosely the gatekeeper. If you were to break down here, so daily failure of 503 underneath and into the weekly range, breakdown of 490, yeah, you're probably looking at a deeper pullback closer to that 480, 477 zone, not the 38.2. It's actually the top of the range should be here as the more important pullback level on the weekly. So one step at a time, and once again, there is no indication of an imminent pullback. Let's take those off and let's go on out to a volume profile here, and let's just take a look at a zoomed out chart, still offering lots of confluence here as a volume shelf and not much to write home about over here. What is this high volume node just for interest? Yeah, it's closer to the bottom end of that 2-week range that we were just describing. Once again, that level would be 490 on the weekly time frame. Last but certainly not least, let's check in on our extension target. We know it's 520, but let's just put it on the chart for everybody to see together here. So coming to the low of the handle, and 520, there it is. So is it really a pie in the sky target? No, we're really knocking on the doorstep of 520. It could be achieved over the span of a week, or it could take a couple of weeks. If we pull back more aggressively, it's still very much so in play as a possible 2024 target. Also, keep in mind that the 61.8 retracement, it would be from here at this point, is top of the balance range as well. We've talked about how that's built in little bit of added confidence to that 480, 477 zone. One final thing I actually do want to show you here on the weekly time frame chart is going out to a max available data set, and we'll take a look at 2008 first. I just want to remind you, if you're looking for an Armageddon style sell-off, you will flip into a weekly downtrend first, and then you get the nasty move, right? Let's go back to the dot-com era, and everybody remembers, oh my goodness, the bubble popped, right? Well, you're in a weekly downtrend well in advance of these large sort of waterfall sells that everybody remembers as the painful moments. So just keep in mind, if you're looking for something really bad to happen in the market, it does take time for a topping process to form. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 514.30, implying a higher high and a new all-time high. And if we're contained by the lower bound, the number's at 501.40, implying a higher low. Given the current daily uptrend, I would argue that this is a bullish weekly expected move. The trend, of course, is up as we've just outlined, but here it is, lows, higher lows, higher lows. Along the way, we had highs, higher highs, equal highs, and we broke out to a new all-time high on that Friday session. It's the highest high in the trend count currently, so therefore we can afford a higher low pullback without jeopardizing the daily trend. What is the top of mind level? Of course, it's this one right here at 503. On the weekly time frame chart, we talked about the 2-bar range, right? And that would really look something like this. If there were a higher low pullback, this would make a lot of sense. Looking to see if we can get buyers to step up at previous resistance, can we use it as newfound support? If we think about this chart logically though, are there any indications that a deep pullback is around the corner? Just like the weekly chart, I would tend to think not really. On Friday, we did gap up and we closed back down inside of the Thursday range, but we're certainly in the upper third of Thursday's range. So sure, could there be some minor selling pressure up here, some profit taking after the earnings report from Nvidia at the all-time high? Absolutely. And if there's a pullback, again, there's nothing wrong with a retest of 503. But does it seem like it has to happen that way? Not necessarily. So of course, any bullish consolidation up here over the low of Friday, we're also looking for trend continuation over time. What if we go for a full gap close? And that would be a violation of the lower edge of this week's expected move. Keep in mind that that's just a suggestion from the options market. You can see that we clearly violated it to the upside last week's worth of trade. But if we were to break down into the gap, which keep in mind, this is another reason why I don't necessarily believe that stronger sellers are here. Let's just evaluate the gap really quickly. Of course, this is due to Nvidia's earnings report, but if stronger sellers were truly in this market and we were opening up near these equal highs, is it not logical that near a known area of resistance, sellers could have stepped up and said, hey, we're going to try to push prices back down through the thin structure? It simply did not take place on that Thursday session. Obviously, we closed strong with a gap and go. So there's really no evidence that, again, stronger sellers are present in the market. But again, let's really take a stretch here and say that we blow through the lower edge of the weekly expected move. We close the gap all the way. So the pullback looks something like this. If we respect a gap fill reversal over 497, technically we have lows, higher lows, and we're coming from the highest high in the cycle, so this could possibly continue the daily uptrend. Now, let's be realistic here and at least concede the point we were trying to make on the weekly, right? If we fail back down into the range, this starts to feel like a failed breakout near the all-time high. Then the risk, of course, is a lower high back down underneath 503. You could start to imagine how this acts as a head and shoulders. And then what's the breakdown, right? If you break down through the neckline, however that may form, maybe it's something that looks like this. This is that weekly breakdown we discussed underneath 490, loosely in here, to achieve the deeper pullback on the weekly chart towards that 480 higher low zone and the previous all-time high. So if you really want to play it out, those are the possible situations as we move forward here as of right now, considering that we don't have any evidence of stronger sellers participating in this market. I would be more so aligned on the daily chart to consolidation and then a breakout, pullbacks over 503 higher lows, or a move into the gap, and then using anything over 497 as another possible daily higher low. We'll keep in our back pocket the potential for a lower high, but as of right now, seems like a lower probability situation. Let's get even more granular now on the hourly time frame chart. The trend is certainly up after the Nvidia gap up, but there's two interactions via price that we really want to focus on that continue to reinforce the idea that stronger sellers are simply not getting involved in this market. Number one is still the the gap up. Notice the lower wick in the first hourly bar of Thursday goes precisely to this prior resistance and this prior resistance as well. We didn't undercut it and then pop back out. We didn't open here and immediately get a gap and go. So what this would suggest to me is that we have very short-term traders who are totally dominating this market. If stronger sellers were truly involved, if JP Morgan gets an order across their desk to short whoever knows however many ES contracts, dump the S&P for some client, whatever, they don't care about this previous resistance, right? They're going to run some sort of algorithm to get the best trade price possible. Maybe it's a VWAP algo, whatever, and then the market's going to move lower because they're going to be unloading at substantial size. Because we're so precise to this level, we have short-term traders pushing this market around, and that, of course, is a bullish indication in the short term considering the large gap up and the fact that the trend is up across multiple time frames. Take that same exact concept and now apply it to the afternoon pullback here on the Thursday session and the momentum in the morning session on Friday to the downside. We go directly to the pullback low and then balance for the remainder of the day. If stronger sellers had any opportunity to capitalize on momentum, that second hourly bar was exactly when to do it. And where did we stop? Once again, very visual, very short-term reference point that only short-term traders are really paying attention to. So therefore, larger institutional size sellers are simply not here, and the chart is pure evidence of that. If we take out a couple of different perspectives, you're going to get confluence at these levels as well. Let's bring out Fibonacci from the bottom of Thursday to the high of Friday. All of the consolidation into the afternoon is over the 38.2. If we come from the bottom of the Wednesday session to the top of the Friday session, the 38.2 is loosely now aligned with the 503. So you're getting great confluence there. So how do we actually want to trade this into the upcoming week? Well, quite simply, any consolidation here is nothing more than an hourly bull flag. We're looking for a breakout. We're looking for higher lows over the top of the flag at 509, and we're trading in the upward direction. If we break down and we're looking for that daily pullback, maybe there's a short-term short on the table here. Let's bring out the red crayon for our sellers. Maybe there's something there, but what's top of mind as we approach 503? Where's the double bottom? Where's the inverted head and shoulders? Where's the hourly hammer candle? And how can we participate here if buyers start to step up for a move back in the upward direction? That would be a beautiful daily higher low. Let's say that we slip into the gap, right? Again, let's bring out the red crayon for the sellers. Let's say that we break down and we do something that looks like this. There's a short trade through some of the gap. I would be mindful of this level here, at least as an hourly intraday trader. It's 499.25, the bottom of this micro balance right there. So maybe you have that one on your radar, but we are technically in a gap. There is thin structure. And if we go all the way back down to the bottom on the daily chart, once again, it's a rinse and repeat of everything we just discussed. Where's the hourly double bottom? Is there a trend reversal down here? Inverted head and shoulders, hourly hammer candle, the whole 9 yards, hold up at 497. And as we know, maybe there's the opportunity for a lower high, something that does this, but one step at a time. So primarily on the hourly chart, I would be trying to align more so with this entry here for a breakout continuation, higher lows over 509, bull flag breakout on the hourly. Sure, we get a little bit of downside. I would be less inclined to participate in this downside here and instead say, where can we participate on the long side at 503? The better short, or at least the one I might look to participate in as a scalp, is moving through the gap. So again, let's bring out the red crayon. Some sort of lower high underneath 503 to move through the gap is interesting to me on the short side as a scalper. But when we get to 497, we are certainly not overstaying our welcome on the short side. Last thing we'll do here on the hourly time frame chart is bringing out the intraday anchored VWAPs, and these beautifully align with most of the levels we've talked about so far. First and foremost, the Thursday opening anchored VWAP is right to 507, so any consolidation above is about as bullish as it gets. Getting a little bit of confluence here, so this is the morning breakout of Thursday. As a level, maybe 505.50 is worth an area of interest to me. The tradable opportunity there is a breakdown that then comes back into the range here, this higher low, supporting over 505.50. Maybe there's an opportunity here, right? It's a look below and fail on the flag consolidation. So that's a possibility, but I would tend to be less thoughtful of this, and more so over time as the week continues to progress, these anchored VWAPs will start to play catch up and confluence at that 503 level. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. Based on the charts, we've already established that stronger sellers are simply not getting involved in the market, but how strong are the buyers who are propping up prices on the Thursday and Friday session? Well, if we look at volume flows, they're not really all that impressive. We never got anywhere close to positive 300 million on an individual session, and net flows on the week are only 50 million. Remember, substantial reads are 500 million. Not even close. If we look at the advanced decline line, never getting into trend higher zone on Thursday or Friday, and the cumulative build looks decent on Thursday and Friday, but remember, substantial reads are 5,000 on Friday. We hardly scraped at 3,000. So we'll give credit where credit is due. It certainly isn't bearish out there. Again, we want to reinforce that stronger sellers are not getting involved, but the buyers don't really look all that convincing. You can even see, and this is in forward testing, so keep in mind we don't have a full data set here yet, but the index score is also more bearish than bullish on the Friday session as well. So what this would speak to, in my eyes, is still the continued concentration risk in something like Nvidia. Doesn't mean go out and short the market to zero, but it wouldn't be unreasonable for a pullback first in the early stages of this week to see if we can respect structure at the 503 level, put in a constructive daily higher low, and see if the nature of the broad market rally truly wants to broaden out. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. We're only looking at the Thursday and Friday sessions. We know that there's a large gap underneath Thursday's session. Here is the value area on Thursday. Here is the value area on Friday. Notice that there's not a whole lot of price acceptance at the highs of Friday's session, and also this D period is very close to the H period single prints of the Thursday session. That's that afternoon pullback low we were just describing on the candlestick chart. The SPY equivalent is roughly 507. So here in the ES futures, we can also take a look at those as sort of two different distributions, the upper distribution on Thursday and the lower distribution. If we're accepting over 507 on the SPY cash level, here in the futures it would be 50.90. If we're over 50.90, this is healthy and bullish consolidation for the hourly flag we were just describing. If we break down from here, suddenly we think of both of these distributions here and here as overhead supply, and we look for the deeper daily pullback to test 503, the SPY level. And here on the ES futures, we would be looking for the low of that Thursday session, much closer to 50.52. Switching gears to the QQQ NASDAQ 100 on the weekly time frame chart, what do we see here in terms of candle structure and location? The weekly bar looks fairly similar, maybe a little bit more of an upper and lower wick, but nonetheless solid green body, strong close in the upper portion of the weekly range. Buyers are in control. On the bar to bar count, this is where things are certainly different. Lower low, but also a higher high. So the beginnings of a broadening formation up here at the top of the weekly time frame. Nonetheless, because of the strong close, I would still argue that for the most part, the buyers do have the upper hand. Think of it this way. If the sellers were going to materialize underneath the lows of the two equal lows prior, right, that was the balance range here, similar concept to the S&P, why were they unable to break down more aggressively and cause a deeper weekly pullback to this level over here, which we've been discussing around 410? So once again, for those two reasons, seems to me that the buyers still maintain the upper hand on the weekly time frame. Let's bring out the Fibonacci's from the low of October up to the tippity top of what we've got here. Again, a structural pullback to 410 is still well above our 38.2. And let's check in from the low of this up to the most recent high, and the pullback low of this previous week went directly to the 38.2. So the way I would prefer to look at the weekly time frame here is really just saying this is nothing more than bull flag consolidation. Can we get a break higher low and continuation for the next leg higher out of the potential uptrend? Let's check in on the anchored view apps and see what's going on from that point of view. We, just as well as the S&P, have added one to the pullback low of the beginning of the year, January. That's exactly the low of last week's bar. So does that indicate that stronger buyers are stepping up? I would certainly think yes, that anchored view app is acting as support. Let's zoom on out and throw on the volume profile. All the same indications here. We know that the previous all-time high, it's not quite confluence with the top of the range, but there is a volume shelf there. This volume node is fairly interesting. It's towards the lows of this weekly broadening range up here. So as long as we're above that, I would tend to think that buyers have more of an edge on the higher time frame. Last but certainly not least, let's take the measured move of the cup and handle to continue to check in on where that number ultimately is, coming back down to the low, and we'll also see how we fared at the 61.8. Beautiful, continuing to use it as support over the last 3 weekly bars here at 425, we'll call it for round number's sake on the weekly, but keep in mind that the target on this one is much more of a stretch compared to the S&P. S&P target is within striking distance, not so much so on the NASDAQ. Just remember that's because the cup is much much larger in general. The distance from here to here, much larger than what we've already seen in the S&P 500. So the summary of the higher time frame is that it's bulls on parade. The sellers failed, breaking down underneath the two previous equal lows. We've got a decent close towards the highs of the 3-bar range now. On the daily time frame chart, we'll first evaluate this week's expected move. If we're contained by the upper bound, the number's at 444.34, implying a higher high and a new all-time high. If we're contained by the lower bound, the number is 429.18, implying some kind of higher low. If we're thinking about the daily trend out of the QQQ, it's not as clear as the S&P 500. Technically, you could go low, higher low, but you could have also gone higher low here and then lower low from there to there. There were certainly some concerns, especially coming off of a lower high here. So for the most part, this chart leaves a bit to be desired trend-wise. I would start to think that it's more neutral, especially considering that the highs along the way, highs technically a higher high open, but it was immediately a failure back down underneath the level. The buyers could not maintain price acceptance over 438.50. So I wouldn't call this an aggressive failure. I wouldn't look at this chart and say, oh my goodness, we're about to fall into a devastating downtrend, but it's just not as clean of an uptrend of what we have over in the S&Ps. So for that reason, if we're looking for weakness in this market, I still think that tech is the place where you want to be thinking about shorts. It was even that way last week. In terms of the structure around us, the candle structure that is, we already sort of alluded to the idea that Friday was a bit of a failure, gapping up over the previous high that was set back here on that Monday session, and the closure inside the midpoint of Thursday's range is a little bit more aggressive to the downside compared to what we had in the S&P. It still wouldn't change much of my idea that the sellers really only have something going on for a potential gap fade if we start breaking down underneath 433.75. There's the potential for a short to close the gap here. Now, the one area that really captures my attention is this previous zone. We remember that previous resistance, in a picture-perfect world, after the first break, would have offered a higher low and then trend continuation. We failed here and then recaptured. We failed again, and this gap up has been sort of a gift to the buyers. You do not want to see price in the QQQ underneath 430 down to 429.15, which is also confluence with the lower edge of this week's expected move. So structurally here, the best thing that the buyers could look for is either consolidation here and then a break higher low over 438.50 on the daily time frame, or a partial gap close, find buyers at 430, push back up to the equal high, maybe it's a higher low pullback again, and then a breakout over 438.50. Regardless, the idea here is that we really cannot afford any price acceptance underneath 430, 429.15 as a zone. If we do, it's another failure from the buyers after being given multiple opportunities to defend and continue to progress price in the upward direction. So if we were to fall underneath, of course you could go full gap close, but then this is certainly a much larger risk. So for that, we'll just take out the red crayon. This is really top of mind, and because we're not in a strong daily uptrend like the S&P, I would start thinking much more so about weekly breakdowns here out of the broadening formation we just saw on the weekly time frame chart. Obviously, for that to really heat up, you would probably look for price acceptance underneath 423.50 on the daily time frame here. Let's move on down to the, and obviously like this should go without saying, but just straight up move above 438.50 early on in the week. Of course, that's bullish, looking for continuation in the upward direction. All right, let's drop on down to the hourly time frame chart for the NASDAQ side of things, see what else we can see in terms of the nuance of the price acceptance or lack thereof on Thursday and Friday. So just like the S&P's very nuanced sort of move in the lower wick of the bar, this one cuts underneath, but notice that there is this as a zone out of the NQ, or I should say the QQQ cash. This prior shelf of resistance is technically slightly below the prior support, which was then the top of the move over here in the midpoint of 2 weeks ago, right? So this still does strike me as short-term traders watching that reference point. Stronger sellers were really going to step up once again. Would strike me that they would have no concern really with this 434.65, 433.75 zone. It would have just been sell it, fill the orders, and look for the gap to close its thin structure below. Simply did not take place. So for that reason, I'm still of the belief that we do not have stronger sellers entering this market, even though it's slightly weaker than what we saw out of the S&P. Same concept here in the first first hourly and second hourly bar of Friday, right to the breakout point of the Thursday morning session. So again, stronger, less nuanced sellers who really had a big order to fill would not care about that particular inflection point, and that was the low of day on the Friday session. So as we walk forward here, what are the possible outcomes out of the QQQ side of things? Again, in a picture-perfect world, fine. A breakdown of Friday's low is not the end of the world. It's still fine, looking for that healthy consolidation up here in this zone over the highs of the 2-week prior resistance, if you will. And then breakouts, higher lows over 438.50 are totally trend continuation. That starts to squeeze out any shorts who potentially initiated on that Friday afternoon, seeing the intraday lower high back down underneath this particular level. Again, it's a little bit more fair to say in the NASDAQ that there were sellers there because it was such a nuanced lower high beneath a previous structure, whereas the S&P was clearly above, right? So sellers start to squeeze on something that looks like this. This is totally consolidation. Again, there's probably a bit more of a short idea here, but when and if we approach that 430 down to 429.15, thinking about double bottoms, thinking about inverted head and shoulders, thinking about hourly hammer candles to look for the reversal back in the upward direction. When and if we could recapture this sort of low of the gap, the top of the gap as of right now. So let me just draw that out in its fullness. Something that looks like this, that's the next step. You're probably along here. If you can pick off the entry from an hourly reversal pattern down here, that also makes sense. But this is a decent entry, and then this as well, back to the upside, is also a decent entry. If we're thinking about stronger shorts, as we talked about on the daily time frame, you're really looking for this aggressive breakdown through the 430 zone. No indications of buyers stepping up here. Lower high consolidation, that really sort of convolutes the daily trend for sure. And now we're thinking about larger time frame breakdowns, daily balance. Does it turn into a weekly top? All a possibility if we're accepting below, again, that key zone at 430 down to 429.15. Let's bring out the Fibonacci's and just see what we've got for an equivalent basis compared to the S&Ps. So your 38.2, the low of the Thursday session, totally acting as good confluence, strong confluence, I should say. For this, consolidation breaks and continuation look great. Based on a Fibonacci perspective, things are concerning underneath the 61.8, so another great piece of confluence. If you break down underneath that, as we know, the odds dramatically increase for a 100% retracement, offering up a possible weekly distribution up here and a breakdown of the higher time frames. What about the anchored VWAPs intraday? Let's throw those on here, and then we'll move along to the market internals. These are mostly offering, the idea would be basically that, again, a little bit of weakness here already underneath the Thursday anchored VWAP. Any consolidation in this zone, it's still okay, and these anchored VWAPs are above our 430 sort of daily line in the sand. So key levels here I think are very straightforward. You're looking for the top of the gap, 434.65, to act as ideal consolidation, breaks higher lows above. Then even if we do pull back more aggressively, it's all about this level right here. I really can't underscore the importance of 430 enough here as we move into this upcoming week's worth of trade. Let's take a look at the market internals on the NASDAQ side of things. Any strong indications of sellers or buyers? And the answer continues to be, not really. Although we were higher based on the Nvidia gap up, you're really not seeing any stronger buyers, especially on that Friday session where we saw a deeper retracement compared to the S&P. Advanced decline line didn't do anything spectacular, and the cumulative builds out of the tick are extremely muted, especially in relationship to what we saw on the Tuesday and Wednesday session. So being more skeptical of the market, you're probably thinking about NASDAQ shorts more so than the S&P shorts, and probably trying to align with a gap close below. Let's check in on the market profile for the NQ futures. Anything big to take away here? Not really. Liquidation break on the Friday morning session. Incredibly poor high from Thursday was repaired. One note here, though, is that you probably don't want to be aggressive for the breakdown, which totally aligns with the analysis thus far, until you're actually breaching Thursday's low. Why is that the case? Because the value area and point of control on Thursday are actually lower in that session. So in order to turn these folks into overhead supply, you have to break down through that low, which is currently around 17,880. If we can break down underneath 17,880, yes, the door is open for that gap to close underneath, and the equivalent level over on the QQQ would be right on over here, 434.65 down to 433.75. If this breaks, the door is open, and we just saw that based on the value area. Most people are positioned on Thursday in this zone right here, not higher in terms of the price action into the end of last week. And lastly, for the broad market, we have the IWM Russell 2000 and the small caps. We're going to kick things off on the weekly time frame chart, looking at candle structure and location as we always do. This bar is certainly more hammer-esque, and you'll certainly notice that it's smaller in range. So structurally, I would still argue that the buyers have the upper hand here. The upper wick is probably a bit larger than that. and probably not ideal in terms of considering it a perfect hammer candle, but nonetheless, buyers were able to close the bar green over the opening print, so we'll give them the benefit of the doubt there. In terms of location, this is really revealing, right? We have ourselves a higher low, but also a lower high. So it's really range compression on the weekly time frame here. One thing that I would point out is that the weekly close is technically over the previous resistance of those 3 bars prior to the larger engulfing bar previous to last week's bar. So just a small incremental step in the right direction here. As we know, we're trying to align more so with the bullish narrative of this acting as a huge higher low. This is all bullish consolidation well over a 38.2 Fibonacci, right? If we do something like that, there was your weekly higher low off of the weekly 200 SMA, as well as that 38.2 Fib. And as of right now, what we're looking for is bull flag consolidation to lead to a breakout over time. And that breakout is incredibly important because, as we see, this is a really large monthly balance range. Almost, it's probably a yearly balance range at this point. If this can break out a measured move, we don't even need a Fibonacci extension for it, just based on an eyeball test, right? We're looking at a range double, bringing us closer to 230, the previous all-time high. This would certainly act as a huge tailwind for the broad market as a whole, and we haven't given up a constructive look on the weekly time frame. So for that reason, I maintain more of a bullish outlook in small caps. Let's bring out the anchored VWAPs because this continues to look really, again, constructive for small caps. The cluster of anchored VWAPs, remember that the dashed gray ones from back here are the previous all-time high, the sickness low, right? The entirety of that continues to act as support here for the weekly higher low. That, of course, is constructive in my view. Let's bring out the volume profile to finish it up. And you'll notice that if we can firmly get some acceptance over this, there's this really low volume void overhead. I'm not saying that we need to immediately thrust up to the next high volume node, but generally speaking, the market is drawn towards those areas. We would think that there's less volume resistance through here until we actually get to loosely 225, let's round up there. Let's call it 225 as a weekly target. The range double, as we just saw, is closer to 230. So overall, weekly chart looks good. Bulls are trying to get this breakout, and that would speak to the broadening nature of the market rally. Let's kick off the daily time frame chart with our weekly expected move as always. The upper bound is at 204.36, implying a higher high over last week's range high, but certainly just an equal high to the overall range and the trend count that we're currently on. So a little bit more neutral from that point of view. If we're looking at the lower bound, the number is at 195.47, technically a higher low from here, but certainly a lower low from the low of last week. So I would really think of the expected move as more so neutral as we're building out that compressed range we just saw on the weekly time frame. You can see that nothing really impressive happened during the course of last week's worth of trade. You're not getting any of the tailwinds from Nvidia's gap up. No surprises there. This is a small cap index. But one interesting thing that happened on Friday is that we closed the gap because on Tuesday we opened on a gap down underneath the Thursday and Friday range from 2 weeks ago. And then on Friday of last week, we closed that gap and then closed right back down towards a key zone. And remember that 199 is that key zone. On the weekly chart, we just sort of mentioned that we closed over it, right? Which we technically did. But from the daily point of view, we wanted this to act as a stronger double bottom neckline. That upper wick of Friday doesn't give me the most confidence that we're trying to push away from it and keep the trend up, because currently we have lows, higher lows, higher lows, and this is your higher low over and right to basically the daily 50 SMA. If this inverted hammer-esque / indecisive doji-esque bar on Friday is going to mean that now this all of a sudden we have this as a lower high, an equal low reattempt to the 50 SMA and the low of the Wednesday session suddenly opens the door for a daily downtrend to emerge, and now we're jeopardizing that weekly higher low we were just discussing, which currently looks great. And if we can stay above, and I would argue 199 is the line in the sand, if we can stay above this, then fine. No real issues to that higher time frame weekly, but if we break down and snap the daily 50 SMA, that's the blue moving average always on our charts here, that becomes much more concerning. So the price action and the candle structure and the trend, nothing really major to read into other than the gap fill reversal in the upper wick of Friday's session on the daily chart. The ideal thing to happen would be the equal highs. Now all of a sudden we have 1, 2, 3 touches in short proximity of time. We're coming off of multiple higher lows. That's ideally what the bulls are looking for a potential break up and over 205, which triggers the weekly breakout and possible range double that we were just looking at. Let's drop on down to the hourly time frame chart here to see if we can pick up on any more nuances of the end of the week, and not really. I mean, again, you can start to see maybe there's a little bit more selling pressure on that Thursday Thursday session. So that's when Nvidia is hot off the press. Everything's gapping up, right? You can see in the first hourly bar of the IWM, we get a little bit of an upshot, which is great. We're over 199, but we actually closed that weak. Now, don't get me wrong, we battle back into the end of the day. It's just not great. It's not really a full-blown vote of confidence for the buyers to retain full control. Now, a decent push and the opportunity for an hourly higher low into the end of day here on the Friday session. So if you're a bull, if you're looking for the most ideal outcome into the early stages of next week, you really want to hold the midpoint of this range here at 199.80 as a higher low. Turn this into a breakout point, break higher low, and then you're looking for that retracement up towards that 205, 203.75 area to really cement the equal high on the daily. So trying to remain constructive here, trying to keep an open mind to the close that's still technically over 199 on Friday, but just not all the way there based on the indications we've got so far. The gap fill reversal still, in my eyes, is seemingly the most concerning component where the buyers were unable to really battle up into the previous 2-day range to look for acceptance. So early on in the week, again, the key for your bulls would be a higher low over $200.75. Let's take out a Fibonacci and come in from the bottom of this move here to the top just to see where we are. Are we in no man's land? Not quite. So again, I think that this just aligns with the analysis thus far. The buyers really want the firm price acceptance over the 38.2 and not to fall deeper into no man's land, which is between the 38.2 and the 61.8. So $200.75, lose confluence with that particular level, and we'll throw on the anchored view apps as well just to flush it out in its entirety. And look at that, beautiful cluster right at 199. So if you're going to talk about a line in the sand, this is technically neutral consolidation. This is feeling much better for the buyers, higher low over $200.75. And if you break 199, this is probably a short for the small caps, and that would not be constructive for the broadening nature of the market rally that we've been talking about as a theme for the past couple of weeks. So 199 key level here into this upcoming week's worth of trade. Let's move along and take a look at the market internals for the Russell side of things. Again, not a strong display of strength from the buyers, especially on Friday, as that gap fill reversal is taking place. Volume flows actually flip back to neutral to end out the day. The advanced decline line does close positive, but it opened negative in the morning session there. The cumulative tick is positive, but once again, is this a strong display? Not really. It kind of fades off into the afternoon there. Could have been better. Really could have been better out of small caps, trying to stay, a bit open-minded, trying to maintain that constructive weekly look, but it's starting to deteriorate, if I'm being honest with you. 199 still a key zone. In terms of the market profile for the Russell side of things, not much price acceptance near those highs of Friday, right? So 2020 is technically the level out of the Russell futures that we've been watching. Point of control is ever so slightly above. The value area is mostly underneath. Again, I think that this more so is just a classic case of not really having a substantial edge in the midpoint of a range. If we just go back to the daily chart and sort of classify this as the range, volatility swing low to volatility swing high, you're smack in the midpoint. What's the rule? Do not diddle in the middle. So compared to Wednesday's close, we've got some major improvements in the sectors in terms of weekly performance. Remember that we were looking at more of a risk-off rotation ahead of Nvidia's earnings, and we said that this really needs to improve if we're going to maintain a risk-on look as and if we broke out to a new all-time high. And I'm thrilled to bring to you that, yes, we did see that shift. So SMH Semiconductors lead the pack. No surprise, they're up 4.17% on the week, followed by the XLF. That one's a little bit of a surprise, right? The XLF is the third heaviest weighted sector by market cap. It's also more of a risk on indication, and then it's industrials, then we see consumer discretionary materials, and way down here is the XLK. So really impressive display seeing the XLF lead the pack there. That to me is actually a bullish component of, if we're looking, I keep using this term, but it's intentional. If we're looking for the broad market rally to broaden out, seeing some relative strength out of financials, absolutely welcome in these current market conditions. At the bottom end of the barrel, it's the XLE energy sector. TLT is thrown on this list now just so we can see how it performed on the week, but then it's real estate, XLP, XLU, all of the risk-off sectors, the lightweight sectors, did shift back down towards the bottom. Don't get me wrong, green is green for the market, but posture-wise, this is exactly the flip that we wanted to see into the end of the week. Let's check in on the structural chart, see if we have any concerns there. Huge gap up out of the SMH, so no issues news out of this one. A little bit of a bearish engulfer starting to show itself on the Friday session. Keep in mind that even if we break down into the gap, a partial gap fill reversal finding support off the midpoint of this range, which you can see was the lows of these 3 bars here. That, of course, would be bullish. You're dealing with a daily higher low there. You're also dealing with a weekly higher low on a pullback to close the gap all the way. Just like the S&Ps, the threat there would probably be some sort of lower high back down underneath 206.50, but we'll take it in stride. As of right now, no issues, any consolidation over 206.50, about as bullish as it gets looking for blue sky territories. Next up is the XLF, where there was that surprising amount of relative strength. Look at the breakout, right? We talked about range compression back here, the break higher low over 39.33. Beautiful move into the end of this week. Gap up on Friday, follow through gap up on Thursday, follow through on Friday. Sure, inverted hammer there, but is it possible for a higher low pullback to remain constructive over 39.80? Absolutely. Prior resistance, top of the gap now acts as support. Beautiful looking chart here. This looks more risk on than risk off. Certainly open-minded to a pullback first, but I think that aligns mostly with what we've already discussed in the S&P. Let's talk about the XLI breaking out to new all-time highs here. Upward pressure is upward pressure. Certainly more of a risk on compared to risk off sector. It's not nearly as heavy weight as the XLF or the XLK, XLV even, but nonetheless, upward pressure is upward pressure. Certainly an opportunity for a higher low. The trend looks constructive here. Let's move along to the XLY, consumer discretionary. What do we see out of this one? Breakout of the range, the balance range over the balance range, right? So go back to the classic Legos. There's your building blocks in the upward direction. Ideally, we stay over 180.15. Consolidation here, break higher low. That would be beautiful. Prior resistance, even more prior resistance at 182, can then turn to support, and the breakout should yield prices or bring prices closer to a target at 187. Again, if we're thinking about the sector rotations here, some relative outperformance from the XLY is certainly welcome. This is a risk-on sector. The largest concern I would have here is if this turns into overhead supply, meaning we would need a breakdown underneath the daily 50 SMA. That level is at 176.50. This certainly wouldn't be great, and don't get me wrong, we don't want to see that if we're bullish on the market, but it's not the end of the world if we're at least holding this as a key line in the sand. Next up is materials, extremely lightweight sector breaking out up and over this prior resistance. Lightweight sectors are always more meaningful when they're breaking huge pivots, so to me, this is helping the broadening nature of the market rally, but again, lightest weight sector, it's not going to make or break us. Let's take a look at the XLK, because like the QQQ, it did not really get anything impressive going, even with the Nvidia gap up. Now, what it did do, though, is save the opportunity for a downtrend, right? If we were looking at highs, lower highs, now we at least have an equal high on the table. If we were looking at lows, lower lows, now there's at least the opportunity for a higher low somewhere in here. Partial gap fill reversal, $200.65 really strikes me as important, being the bottom of this as a previous range, right? So I'm open-minded to all of those things. Again, the gap up on Friday didn't really yield anything impressive. Consolidation up here looks great. Looking for something that does that. That, of course, is bullish for the broad market. Closing some of the gap. Yes, we are looking for pullback in the S&P, but once again, I think that really aligns with what we've already talked about there, based on the internals and the lack of performance, right? Let's take a look at the XLC. What's going on with communications? Beautiful flag range up here in terms of weekly flag range, right? Not the greatest looking bar on Friday, but still not the end of the world. Continued consolidation ideally stays over the 50% mark of the range. Break higher low over $80.05. Don't forget the 5 cents. That's looking good in the upward direction. And communications are, of course, risk on. Larger concerns when and if we break down to close this gap. Certainly an opportunity for a weekly higher low maybe at this 77-ish zone. Not thrilled about that, though, because then, of course, lower highs below kick off some sort of stronger daily downtrend, right? Next up, let's talk about the healthcare sector breaking out to new all-time highs. Any concerns? No. D for defensive, but second heaviest weighted sector by market cap. If any of them are going to be breaking out to new all-time highs, this is the sector to do it in. Great looking uptrend here, consecutive higher lows, like beautiful. This belongs in a textbook almost, where prior resistance is acting as newfound support, right? We're looking for the same exact interaction up here, some sort of pullback, finds support at previous resistance, pushes back in the upward direction. Beautiful bulls on parade. Next up, XLU utilities. They were outperforming earlier on in the week, but does this chart look like a concern as of right now? The answer is no. This is still a downtrend, still an opportunity for a lower high. Rejection of the daily 50 SMA. This is a risk off sector, so we don't want it outperforming in a big way. And it's not, so no issues, no red flags. Next up, XLP. A little bit heavier weight, and it's also a risk-off style sector. It did break out to a higher high in the trend count, inverted hammer on Friday. But if we think about where it is relative to previous pivot tops, like the XLV, or I should say unlike the XLV, it's not breaking out to new all-time highs. We don't look at this sector and say, oh my goodness, run for the hills. There's massive outperformance from the XLP. No, this is a decent uptrend. Upward pressure is upward pressure, but it's not outperforming to a major degree where we would say, again, there's something wrong with this market. Real estate, let's take a look over here. Nothing major, still stuck sideways in this range, moving along. It's a lightweight one. TLT, we'll look at ratio to the S&P in just a moment. Up day on Friday, which is interesting because obviously the S&Ps were down, but no major concerns. Again, we'll look at the ratio momentarily. And energy really trying to get the break of the inverted head and shoulders neckline, not all the way there yet. Ideally, this consolidation just slowly creeps higher, right? We don't want energy falling off of a cliff, but we don't want it skyrocketing either. That, of course, would not speak well towards our inflation expectations. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Still some minor red flags continuing to emerge from this particular view. The XLK doesn't look great here, rejecting for a potential lower high underneath a now flattened out 50 SMA. Ideally, this pops back up and over, maybe consolidates above as the XLF also breaks back up towards these equal highs. The XLF does look good on the potential higher low over the 50 SMA, almost the inverse of the XLK. And as we know, financials are the third heaviest weighted sector and a very risk-on indication. XLV is starting to become like, okay, we'll keep an eye on it, right? We know it's breaking out to all-time highs. It is the second heaviest weighted sector, so we don't want it falling off of a cliff, but if this really starts to capture some steam and really outperform in a major way, raises some minor questions. XLY, also a bit of a red flag, like why can't we get something stronger going on here? Why are we rolling over relative to the S&P? This should, in a better world, be playing more nicely with a retest at least of the 50 SMA, if not a recapture. The XLI looks decent. XLC cooling off, but well above still an upward sloping 50 SMA. These have backed off of the 50 SMA, so this was a risk-off indication as a potential threat earlier in the week. It's backed off, so no issues, and the XLU never actually came close to the 50 SMA. If we take a look at some specialized ratios, again, we'll start seeing some slowdown here. The XLK SHY coming in for an equal high, maybe even a very nuanced lower high, but not breaking out. It certainly does not look like this, right? So if the market's really going to pick up more steam in terms of risk-on nature, you want to see a higher high out of this ratio. We haven't done it yet. Let's take, but you know, the flip side of this coin is that nothing looks bearish. Nothing is jumping off the page saying, oh my goodness, market's going to zero, right? Just a little bit of lackluster performance from the risk-on side. The XLK XLU, same commentary, the opportunity for a lower high here. Maybe it turns into a head and shoulders and maybe it breaks down. We haven't done it yet, so still trying to keep an open mind to continued consolidation, maybe as a weekly sort of flag consolidation zone like that. Let's move along to the XLY XLP. So this is apples to apples. This one still looks good. Still looks good. Ideally, it would have made it back up to the equal high, but the continued hold of 238 does strike me as a bullish indication. We will take it very seriously if this breaks down underneath this as a swing low. If that gets taken out, this now, of course, becomes a lower high, and we're aiming for the bottom end of the range. That would speak to a risk-off rotation in the market. Again, haven't done it yet, but keeping an open mind to it. And again, because this is apples to apples, not like your XLK compared to government-backed, very short-term bonds, we'll take this one much more seriously, all right? Next up, we've got the SMH XLV. And this did break to a higher high into the end of the week. We also know that the XLV is performing quite well. So the fact that semis even outperformed the new all-time high in the healthcare sector, this continues to sort of back up the idea that, yeah, although things don't look great, it's certainly not concerning, and it's probably slightly more risk-on than risk-off out there when we look at things in their entirety. Let's jump over to the dollar and see what's going on from a currency point of view, finding some support over the top of the previous range here. No surprises from a technical point of view. If we do get some sort of uptick back to these highs, wouldn't be surprised to see a move lower as a headwind for equities. What could be a possible catalyst for that? How about the PCE that we mentioned earlier on in the intro of today's video, something that we'll watch out for on the Thursday morning session. Let's take a look at gold and the metals to see if they can give us any heads up. Gold is still stuck in the midpoint of the range, so just like the IWM, don't diddle in the middle there. SI for silver could not quite get a breakout over the neckline of this as an original double bottom. So now we'll be open-minded to, okay, can we get a higher low? And if so, can we reattempt the equal high in short proximity of time? If we could get a break there, that of course would speak to the dollar maybe coming down a little bit more to alleviate headwinds in equity. So just trying to keep an open mind to that. I think now that Nvidia earnings have sort of come and gone and the market's held up okay, the focus is going to shift almost, I don't want to say instantly, but fairly quickly back on over to interest rates, the Fed, the dollar, and everything that's going on with financial conditions. So just watch out for that as we start navigating the coming weeks worth of trade. Let's finish up this stuff with interest rates, TNX backing off of 43. As we know, that's 4.3 in the 10-year. So as long as we're underneath that, it's still looking okay. Not in love with the activity for potential flag consolidation over 42. I would feel much more comfortable about interest rates if we're under 4.2 in the 10-year. So watching out for that potentially to break if PCE comes in okay. If it's not hot, if PCE is just normal, then great. We'll look for a move under 4.2 in the 10-year, alleviating some pressure in tech. Not that there's been any major pressure in tech, but it would certainly act as more of a tailwind. Let's finish it up with the inverted ZT. As it continues to creep higher, as we know, that would just mean that we have lower odds of a Fed cut come the month of May. But let's take a look at the tracker tool. So as expected, and no surprises over here, continued odds of a pause even out to the May timeframe, which is exactly what the inverted ZT was just reinforcing. 73.8% odds of a pause for that May timeframe. And then from there, 1, 2, and 3 cuts into the end of 2024. Half as many as what we were pricing in originally. We had 6. Even just as soon as January. Now, unfortunately, FactSet did not release their earnings report, which is kind of ironic considering Nvidia was like the largest deal of all of the earnings season. But I have to imagine that blended earnings made an uptick, especially in the technology sector, with Nvidia reporting better than expected outcomes and strong guidance going forward. So that takes care of sort of the balance of fewer rate cuts, but blended earnings moving in the upward direction to justify the pricing basically of the S&P from a fundamental point of view. If we look at the calendar here for the fundamental side of things this week, as we know, it's really all about the core PCE on Thursday. It comes out at 8:30. We'll be live up in the penthouse here, coffee and donuts on me. If you want something different, that's cool. You can bring it. Just bring enough for everybody. We'll also continue to keep an eye on unemployment claims. This week really blew out the number, 201,000 versus the 219,000 as an expectation, which totally flies in the face of all the anecdotal headlines that you see. That's like, okay, WeWork, Toast, all these things just laying off people left and right. Oh, there goes 10% of the workforce. Unemployment claims do not suggest that we have any issues with the labor market. And also, we had a lot of Fed speak last week, and I think it flew under the radar considering everybody was so focused on Nvidia, right? But if you actually read some of the commentary from the Fed, a lot of it was about like, hey, what's the rush to cut rates? Like, we're really not in a hurry here. The labor market remains resilient. Inflation saw a little bit of stagnation the last go around based on CPI. Let's make sure that we nail this thing down before we prematurely cut rates, which is almost exactly what Jerome Powell said during the FOMC press conference way back in January, right? It's sort of like his little minions are coming out and reinforcing the idea that he's already set forth. So if we take a look at what we have for this upcoming week, let's go back to PCE and talk about expectations. I mean, this is a hot PCE. 0.4, that is really not what we want to see. The annual read, I believe, is slated to come in at a 2.6. It's still not 2%. So we're looking for that to continue to move in the downward direction. Someone correct me in the comments. I don't have it up in the screen in front of me. Did I mean to say 3.6? I think I did. We're moving in the right direction. I'm actually getting this all thrown off now, and I don't want to misspeak. So I'm going to edit on the screen right now what it should be. That way you have the most accurate information. And I'm just going to shut up and move along to the earnings calendar, which, as we can see, none of this stuff is going to hold a candlestick, no pun intended, to Nvidia. Maybe some honorable mentions here. Unity will be interesting because they are involved in the AI space. If you want to talk about lows from a home builder's perspective, that might be interesting. Devon Energy will be a big one here for the XLE as a sector. Some cloud compute, if you want to take out your popcorn, you are going to get AMC. C3AI, if you want to hear more about the AI sort of mania, if you will. That's really it. That is really it. I'm not too interested in anything outside of that. SoundHound is coming up from the rear as an AI company as well. Maybe worth keeping an eye on. But for the most part, we've got the big stuff out of the way. Let's take a look at the risk appetite. So although we acknowledged just a couple of moments ago that the TLT had an impressive up day compared to the equities down day on Friday, notice that the ratio itself has not done anything to suggest a huge flight to safety trade is unfolding. So that, of course, is bullish for equities down below. Let's take a look at bonds in relationship to themselves, and what you'll notice is a small and subtle reversal of the ratio into the end of last week. This, of course, would be a risk-on indication, but also more of an indication that the market could start to become more comfortable with the idea of June cuts from the Fed. Let's take a look at credit spreads, and as we know, these continue to sit on their lows, so no issues over here. Credit event does not look imminent, no risk from that perspective. And we'll take a look at the high yield in isolation. Broke the trend line here, but still a lower high if you're counting from here to here, whereas equities obviously produced that higher high. It's continued to be divergent, and as you know, we've really built the case so far for a pullback first in the S&Ps based on the internals weakness there. So it's not that we're looking for bearish activity, but this might keep us a little bit skeptical in terms of participating at new all-time highs or chasing higher highs as a potential trade. What about Bitcoin? Bitcoin is consolidating sideways after the break of the range. This is starting to look more so like a constructive flag. That, of course, would be bullish and supportive of strong risk appetite. Then we can move into some breadth indications. Really strong display out of new highs versus lows into the end of the week. Ticking higher here is bullish. Same thing out of the SPX A200R, making a move back up towards the equal high. Not all the way there yet, but certainly a lack of breakdown would speak to the broadening nature of the market rally. So under the hood, the breadth really isn't terrible. Could it be better? Yeah, I guess things could always be better, but hey, what more could you ask for? The SPX A50R certainly moving in the upward direction. This looking like a reversal off of the 50% mark. That, of course, is bullish for the market. And as we know, the king of kings in terms of breadth readings over the last little bit has been the RSP equal weight S&P index, breaking out. This did not stutter step. It's not like Nvidia was the only thing that moved higher into the end of the week. The equal weight index also saw that breakout, and that, of course, to me, is more of a bullish indication. Let's take a look at the QQQE, the NASDAQ equal weight, also moving in lockstep with the weighted index down below. No huge divergences there. The Dow Jones Industrials versus Transports still lagging in transports, but we'll see if we can break up and out of this range. The one good thing, at least, is that this breakdown did not yield lower prices into the end of last week. Notice that Tuesday and Wednesday were lower. Certainly possible. We know that Nvidia is much more tech concentrated, certainly not going to have as much meaning for transports. But if transports were weak here and broke down from the range as this was doing that, much more of a red flag. So the fact that this is still in the range, it quells some of the concerns out of this divergence, but it's still not totally resolved. Let's move over to volatility. Nvidia earnings reported, and boom, we're right back down underneath 15. No issues out of the VIX. The VVIX itself, volatility of volatility, getting closer to complacency zone at 75, so we'll keep an open mind for that. But as of right now, no issues in terms of volatility. Lastly, vol futures. What do we see over here? Strong contangos. Look at that move into the end of the week. The market's not really seeing any risk from a volatility point of view. If you've made it to this point in the analysis, I'm sure you're enjoying the show. Do me a favor, make sure you've hit the thumbs up button, subscribe to the channel, drop a comment down below what your favorite part has been so far, or if it's yet to come, the trade ideas, of course. And we'll kick off the core list of companies with none other than Apple. What do we see here? We're on an hourly time frame chart, FYI. This certainly could be some sort of inverted head and shoulders, but you need to produce that right shoulder and hold instantly on the Monday session 182.50. If that's the case, your neckline breakout is looking for acceptance over 184, and the idea is to look for a little bit of a counter trend move into 187.50 and then a daily lower high at this level. I wanted to start with the counter trend because it maybe seems a bit more top of mind with the more bullish nature of the analysis thus far. But if we go to the daily chart of Apple, really doesn't look all that convincing. We have highs, lower highs, lower highs, possibility for lower highs. So the inverted head and shoulders is somewhat in here. The counter trend move is looking for that lower high again up against 187.50, which makes sense. It's the breakdown using this as overhead supply. If Apple is just going to remain weak and trade back down towards 180.25, you can see how this is a flush point, a big breakdown there. The better structure, it's way down here at 173.75. You might get something at 176.75, so keep an open mind for that level. But the door is open. Apple does have relative weakness, a clear downtrend. Doesn't really look all that great on the daily. Let's move along to Microsoft and see what's going on over here. Leaving it zoomed out first, then we'll get down to the hourly. You'll notice that if the gap closes, technically speaking, there's a higher low, and this really just looks more so like a look below and fail. So keeping an open mind for that, that's 402.25 on the gap close. Even better would just be price acceptance over this as a daily balance range. 408.60 is the top of the gap. So this consolidation is great. Let's take it down to the hourly now, though, so we can see how you need the higher low intraday over 412.50, right? That's the high of the Thursday session. It was support from back here, previous resistance, XYZ. So 412.50 is the key for upside. This consolidation is okay, but if you're looking for the long, you probably want to see something that looks like this. We'll trade scalps to the downside through the gap because there is thin structure, but again, reevaluating at 402.25. Next up, Google, what's going on? It's not really playing nicely with the AI story, right? This one has been lagging the AI move, not doing anything impressive on the Friday session. The only bullish thing you could argue here on Google's chart is that we did technically put in a gap fill reversal on Thursday. Look at the first hourly bar. It's an entire container bar for the compressed range. Obviously, Friday is an inside bar, so a very classic setup is just looking for a breakout of the container. If we break to the upside, looking for the gap to close overhead. If we break to the downside, probably looking for a retest of this as an inverted head and shoulders neckline around 141.50. Is there a trade that unfolds there? Absolutely. You can see the dotted line underneath the low of Friday. I think the door is open for this as a short, right? So 143.50 breaks lower highs below, looking for a stronger retest of this level right here. You might argue that the gap fill reversal is an important level. I would tend to think if there was an opportunity to get movement back in the upward direction, should have come with the follow through from the broad market, like midday on Thursday or on the Friday follow-up session with that morning momentum run to the upside. Just simply did not take place. So therefore, this to me is a stronger downside possibility. Let's move along and talk about Amazon. What's going on with Nancy here? Daily time frame chart, gapping back up to the top of the earnings range, staying above the earnings range. So very straightforward setups here. Obviously, the best pullback is a higher low over 172.35. You could still technically pull off a higher low gap fill reversal off of 170.25. And if you're getting an equal high break over 176, there's some room to run here, at least intraday. It would be a large range to trade for up at 179.50. Here it is on the hourly time frame chart. You can see that if the sellers were going to make something happen, this was their time to shine immediately on the Wednesday session, not even on the Thursday gap up from Nvidia earnings, but on Wednesday, they turned it directly into a look below and fail. Consolidation in the range was setting up a bullish trade. Obviously, the gap up continues to further the bullish nature of Amazon here. So we're clear on this one. Let's go back to a daily chart and continue along with Nvidia, the one stock to rule them all. Volatility is slowly creeping out of this, as we know. The best pullbacks here structurally on the daily, just a reattempt of the a quadruple top here. You did get some, again, just like the S&Ps basically. The S&Ps are almost a mirror of this, but a little bit of gap close. Where did it support? Right off of the level. So again, are stronger sellers getting involved here? The answer is absolutely not. Interesting thing to point out, and a big shout out to Theo Trade. Don Kaufman does a much better job of explaining the dispersion trade than I could. But if people are technically forcing market makers to sell Nvidia calls, market makers hedge their bet, right, by buying the underlying to reduce their directional risks, right, basically. So what that would mean is you're like, who the hell is buying Nvidia at 800? It's not necessarily new money longs, it's just market makers hedging their risk off, right? So that is one possible explanation of why this continues to move in the upward direction. If you don't, if you're not familiar with the Nvidia options chain, just take a look at how many contracts went through on the Friday session. 3.1 million. 3.1 million is huge. Apple is typically like one of the larger, more liquid products. This one hardly did a million on Friday, all right? So just to give you an idea of kind of the amount of volume flowing through that options trade, and therefore the amount of hedging via shares that might actually have to take place here in the underlying itself. So nonetheless, the levels to be paying attention to, clear consolidation over 773. If we take it on down to an hourly chart, you can see that one. Your afternoon consolidation balance lows, pullback low from Friday. Anything that's in here is not the end of the world. Huge daily higher low over the 741.25 quadruple top we just discussed, right? So that's bullish here. Looking for this higher low over 802.85. That should be, oh my goodness, round numbers only up here in the penthouse. Please, who let that one slip by? So this is solid blue sky territories. If you do break down under 773, I could see this as a short because it's thin structure. There's really not a lot of volume at price through this sort of Thursday morning breakout. So there's a potential short here, but please just be careful if you're going to short Nvidia, the one stock to rule them all. The better short is probably looking for a move through the gap here on a lower high underneath 741, goodness, 25. Let's finish up the core list here with Meta, then of course Tesla, Netflix. What do we see on the hourly chart for Meta? Great attempt for a possible higher low here. It's got to hold though. So 482 leaves a bit to be desired. Not really seeing any bullish indications into the end of Friday. Ideally, maybe Monday morning we produce some sort of consolidation here, then get a break over some equal highs or something that looks like that. Maybe there's an offering of a strong hourly hammer that looks into the range and then closes above. We're long over the top looking for follow through. So ideally 482 holds, but I'm not seeing anything yet that has me like totally interested in that trade. If you're going to be a seller out of Meta, there's really only a couple of places, right? Maybe there's a scalp through the gap close, but the better sell side opportunity is probably here, turning all of this into overhead supply. I would not jump the gun on the short because we did technically produce a higher high from here to here, and there's an opportunity for a huge higher low. right? So trying to align with the bullish trade, just not seeing it entirely yet at 482, watching that level closely. Tesla is up next. The inverted head and shoulders still on the hourly chart here, folks. Inverted head and shoulders did not really resolve as cleanly the 193 retest as I would have liked. Nonetheless, this is building out as a balance range. You're going to probably start respecting 190 a little bit more so than the 193. I do think 193 will maintain some importance, but 190 is much more of a line in the sand here. The buyers want to see the breakout of the range with a higher low over 198.25, close the remainder of the gap overhead. 206 is that level. Chopping around in the range leaves a little bit to be desired. A breakdown underneath 190 with a lower high here. Probably looking at this as a failed reversal out of Tesla's daily if we just take a look at that, right? So this is certainly a daily downtrend. And as we know, the earnings gap down put us right towards the lower trend line channel, right? So if you do something like this, we gapped into it. So if this is going to be a stronger reversal back to the upside of the channel, this inverted head and shoulders really needs to stick for the daily reversal of trend. Then we can start aiming for these things one step at a time. If that 190 fails, it would leave me not so thrilled about the opportunity to move to the opposite end of the channel here. Next up, let's finish it off with Netflix, and then I've got 3 trade ideas for you on this weekend's update. What do we see out of Netflix? Just balance on the Thursday and Friday session. It is balance over the top of the previous range. So to me, it's a step in the right direction. We have lows, higher lows, potential for higher lows. The best long trade is probably looking for something over 590.25 to trade to the equal high. From there is room. 616 is the next larger target overhead. So if you're a daily or longer time frame trader, 616 is probably what you're aiming at, as long as we're over, again, that 579.20 top of the previous range here. Where the sellers have their edge, just like Meta, you're probably being patient on the sell side until you're actually underneath 558.25 for some sort of lower high. All of this is now overhead supply. The gap is the big risk to the downside. All right, here we go. 3 trade ideas, and then you are out the door. Dash. Speaking of doors, DoorDash is the first idea. DASH is the ticker on this one. Inside bar on Friday. Large upper wicks, rejecting the highs of the Thursday and Friday session, with a gap to close underneath. No surprise with the whole, rising tide lifts all boats from Nvidia on Thursday's open. So if we can break down underneath the lows of the 2-bar range here at 120, looking for the gap to close. Now, would I overstay my welcome on the short side? The answer is probably not. If you zoom out of this chart, this is certainly an uptrend, and it looks like earnings went quite well via some sort of gap down that was retraced, and now we're trading back up towards these equal highs. Don't get me wrong, not up to this high, but certainly things have not deteriorated in a substantial way. The trend is up. I would try to align more so with a quick gap close. Maybe even the gap fill reversal is the trade for you, finding buyers at 117.20, if that makes more sense based on your psychology. Here it is on the hourly chart, just so you can see the range intraday. Sharp rejection in the morning session, then really failing to get any acceptance back up towards that wick, producing a lower high into the afternoon. Again, the idea here is a gap close and then possibly a gap fill reversal off of 117.20. Next up, we have ourselves DIS, Disney. What's going on with Disney? Big gap close underneath. That has failed. So setting up on the Thursday session was actually a 3-bar play to the downside after a 100% retracement, right? Inside bar on Thursday means that we're looking for a breakdown of the equal lows. There's thin structure because of the gap underneath us from earnings. Sellers should have no problem pushing this thing lower. What do we see on Friday? Long-legged hammer candle. Some people call that a dragonfly doji, right? Whatever you want to call it. If we can break out now up and over this set of highs, we'll see it on the hourly in just a second, we've got a thin structure retracement back up to the equal highs as a potential target. Let's go down to the hourly so we can get a little bit more granular. A couple of ideas come to mind, right? If you're a classic pattern trader, you just want to see higher lows here, build out an inverted head and shoulders. This turns into a neckline, and we're looking for that move back higher, closer to 112. What's the number to be precise here? 112.50. 112.50. Let's round up there. We know the rule number 2. So there you go. That is Disney on the upside based on the hammer candle from Friday and the failure from the sellers to really rotate through that gap range. Last trade idea for you, and then you are done for the weekend. INTC Intel, fall from grace. It's just completely sort of drifting off into the shadows based on what's happening with AMD, obviously Nvidia. So as we look at this chart, what do we start to see? And this is a trademarked pattern, so don't you dare. I'll send the lawyers. there's your man ray, right? Let's give him some eyes. Nasty little, ugh. There you go. So if you break down underneath that neckline, your right shoulder here, under 42.50, the door is open through thin structure for a 200 SMA daily retest at 38.35. That's close enough to a round number here on a sub $50 stock where it will do, but that's the name of the game. You can clearly see it did not perform well with any of the Nvidia good news. It tried to gap green over red, but bearish engulfing bar, 3-bar play into the Friday session. This is almost like Disney, right? So Disney was looking like this, 3-bar play. Disney, of course, looked below and failed. So that is a possibility out of Intel. But what we're looking for is a breakdown of 42.50, lower highs, and continuing to rotate through that thin structure that we just saw on the daily down towards 38.35. That's going to do it for this week's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live every morning this week at 8:15 for our pre-market prep. Don't forget coffee and donuts on Thursday for PCE and unemployment claims. And with that said, I wish you a green trading week.